Okay, good afternoon. Hello, everybody. Today is October 7th. The market just closed. This is your weekly take on the market. I'll be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Let's take a moment to read the disclaimer, please. We are not licensed at IBD. We don't make buy, sell, hold recommendations. Where we like to stay in our lane, so to speak, is research and education. Okay, so the drill is the usual. We'll talk about the market, the indices mostly. We'll get into some charts that I came across. It's been a couple of weeks since I did this, so I have a handful of charts, things that are interesting to me. I know I've mentioned it before. I like charts. I know you can manipulate a chart a little bit with the X and the Y axis, but I think it was Scott Galloway who was talking about pictures, how much more information us as humans take from a picture versus words. So maybe that's why I tend to gravitate towards these charts. We'll do the industry groups and then some stocks that are on my radar of interest, and then the quote of the week. So let's start with the indices. Let me pull up my MarketSmith. Now it is 1:15 my time, so the market has closed for 15 minutes. This volume figure will not be up to date. The price figure will be pretty close. We could always look at the QQQ if we had to, but it was a terrible day. The jobs report was if the jobs report was good, then that's bad. I think it's backwards. I guess because the Fed is going to have to continue to hike interest rates is what the market is pricing in. So it was a really bad day for the market. Opened on a gap and just stair-stepped lower all day long. If you look at the bond market, which is TLT, undercut this low, it's way below this low. So you can see how much weaker than the market is. This is roughly 8% lower, where the NASDAQ is just basically at those lows. The S&P, right on it as well. So the bonds, are somewhere down here, and it's just been a terrible, terrible year for fixed income, and it could cause some dislocations. There's worries about Credit Suisse, and then the Bank of England had to step in. They're about to do a speech on quantitative tightening, and they had to step in and add some liquidity for pensions. What a year this has been, right? May you live in interesting times, allegedly, Confucius said. So the markets are very interesting. Hopefully you're navigating them as well as can be expected. It is definitely not easy. This is a year for survival for sure. Now, some of you might have been doing well if you like to short. There's been a plethora of short sale opportunities, and then there has been in the energy sector some mini to pretty good trends. We'll look at some of those stocks. So it hasn't been a total bust as far as possibilities, but it's definitely been a crazy year. If I go to let's look at the opposite of the bonds, which is interest rates. Got a little list down here. So here's the 10-year note, and I'm going to turn my camera off so you guys can see this a little bit better. But if this was a stock, we'd all want to be long it. If I go to the weekly chart, look, it's up. Look at that. 1, 2, what is that? 12 weeks in a row. That's incredible. Here's the 30-year. So, pushing highs. This is the highest the rates have been in, what's that, 8 years? If we go to the monthly, it's not the highest it's ever been, obviously, especially in my trading career. I started in 1995, like right here. So interest rates were much higher. And so the market or the economy probably could handle interest rates higher. It's just the way that they've gotten there. It's so fast. This move 16 to 38 is, 2.5-fold roughly, not including this move way down here. So the market has obviously had a really difficult time with the move in interest rates. Here in the short end is really moving. Here's the 5-year note. So in, the COVID low is 2, and now we're pushing 40. I know it's kind of an artificial low, but wow, 20-fold move. So that's what we're fighting as equity investors. We are definitely swimming upstream. I think I mentioned in my video 2 weeks ago, it's a bear market. Proceed accordingly. It is a bear market. I will get long a little bit, some energy stocks here and there. In fact, this morning I was having a fantastic day. My energy stocks were up, my shorts were down, as the best of both worlds. But then the market just it was too bad. The pressure from the index is grinding lower. People start looking around, institutions start looking around, and a lot of these energy stocks will lose a bid, and they all kind of came in. So that's the problem with being long in the bear market. Relative, they did really well, but they still were down. So I'm an absolute investor, right? I'm trying to make returns above zero. If the S&P goes down 30% and I go down 22, that's a bad year as an absolute investor. That's a pretty good year as a relative investor. If you ran a mutual fund, you can, say you beat the market, but that's not the game that I'm trying to play. So being absolute is a little bit, it's tougher for sure. So you're trying to, make total returns. So that's where we are. Let's jump into the slides that So bear markets are explosive. Hulbert ratings is the source. The distribution of daily changes in the S&P 500 since 1928. And you can see in bear markets, there you get much larger days. Somebody was on a podcast, and I think the NASDAQ was up 3.5%. Maybe a week ago or something. It was last Monday, right? There was worries about Credit Suisse. On Monday we come in, there's no news, so the market, they jam the market. That's bear market action. You really want to see the markets kind of stair step higher. The best types of markets are 1%, 0.5%, 3.3% day after day. So usually, as a general rule, bear markets grind lower. They go lower, and have explosive up days. Bull markets are just the opposite. They grind higher, and have explosive dynamic down days. So it's a good kind of mental thought process when you think about how the market was reacting, what kind of market you're in. Plus, I've said it 100 times, and simple rule: if you're below the 200-day moving average, you don't have to call it a bear market. You don't have to call it a correction. But it's the old adage, nothing good happens after 2 a.m. Well, nothing good happens in general in the stock market below the 200-day moving average. So we really have a long way to go. Let's pull that up. I'm just curious how far below the 200-day we are on the indexes. So we are 16.5% below the 200 on the NASDAQ. Gosh, that's a long ways. So we are stretched to the downside, and that's what makes people think, oh, let's go ahead and jump in. Hopefully we can catch a rally, or the market's oversold. Yeah, I saw one guy on Twitter say he was buying the market. It was last Sunday. He was buying the market. It was this was Friday, I believe. This was Monday. So he was buying the market here because no one else was. I don't think that's a very good reason. Somebody is always long the market. Somebody owns these stocks, and for every buyer, there's a seller. So it's kind of a misnomer that, there's no buyers. Today there were no buyers. You might hear that. Well, there were buyers. People were buying stocks being sold. I sold some stocks today. Somebody bought those. It's just that what's happening, dynamically, psychologically is, I'm willing as a seller, let's say, to take a worse price because of the market environment or the news. And the buyer is only willing to buy at like a price that he deems really, really good. So that's how stocks go up and down, really. It's just a change in perception of the price, because the market is loaded up with, I think there's 80, somebody said there was 8,500 equity ETFs out there, and they own stocks. They have to by mandate. So they're all loaded up in Apple and Tesla and Google and Microsoft. And so as people start to feel the pressure of the bear market and start selling those ETFs, they have to unload those positions. And right now, as we speak, I just don't know who's going to be a buyer of these positions. The who thing makes me laugh, because I was listening to a podcast, and somebody said in the 70s, I think they were saying they had some bad positions and they wanted to sell it, and they would call it an owl market, OWL, because you would call your broker to sell, and your broker would say, to who? And I don't know why I find that so funny. I find that it's like a dad joke, but that's very funny to me. To who? Who am I going to sell these positions to, right? So that's kind of what's going on in the market. The Swiss National Bank, they own it. 5% of their balance sheet, roughly, last I saw, is Tesla. 5% is Apple, something like that. If they have to, raise cash to do some kind of bailout of Credit Suisse, where are they going to raise cash? These are the most obvious places. So that's why you see, and we can go to those stocks later, but that's why these stocks have suddenly was so strong. Apple had an RS line new high, like this whole way up, but eventually in a bear market, they get them all. Okay. Big money is hedging as the market slides. Premiums for put contracts are spiking, and so if you run an institution and you want to hedge, there's nowhere to sell. A lot of them have to stay fully invested. So it looks like they're willing to pay up for insurance by buying options. I don't know. A lot of people might think that's bearish, right? They're buying options, buying put options at the end of the downslide. But this slide, I think I took this a week ago, so it worked for a day or two. But here we are back at day lows. Hedge funds and mutual funds are slashing exposure. Here's Goldman Sachs Prime. You can see the trend, but they're still pretty heavy as far as total exposure. I mean, they're way above like something like 2012, 2016, even the COVID lows when they came down from an exposure standpoint. So they are reading the tea leaves. Institutions are trying to lighten up, trying to get smaller, so to speak. That's a thing that I hear a lot when I would speak to people who run money. Get smaller. If you have a position, Stevie Cohen will tell his traders that, get smaller, just get smaller. If you don't want to get out, get smaller. If he would tell his guys, if you have a position that's going against you, cut it in half. And then if later on, if it's still going against you, cut it in half again. And so you've literally reduced 3/4 of the position by doing that. So you always want to think, if you're not doing well, get smaller, smaller. If you're doing well, that's what we do. We press, we add to the winners, get bigger, bigger, add to those winners. So this is definitely a get smaller market. The bull bear ratio, extreme to the downside. People are pretty negative. Obviously, there's a lot of reasons to be negative. That's not a good reason to be positive, to go the opposite way. But it could tell you that, like, if you're short, the market's pretty stretched. So I haven't been pressing my shorts. I've had shorts on because I like having that balance between long and shorts a little bit. And I have a couple of names that I really like from the short side. But I haven't been in this last few weeks pressing the short side aggressively because, these types of charts. Now it's been wrong. And I mentioned Charles Harris, who said that this is the one year that sentiment is kind of steered him wrong. He's been using sentiment for a long, long time to his benefit for sure. And this is just one of those weird years where sentiment has not worked. Apple, I talked about Apple very briefly, but here's the weight of Apple. It's way overowned. It's too big a component of the S&P. It's in every single ETF. You'd be hard pressed to find any kind of ETF that doesn't have a position in Apple. I'd be curious what the percentage is. I guess there'd be energy or solar ETFs. But if it's just a regular growth or ESG or value or dividend, any kind of mandate, you could probably stuff Apple into. And so it's really just a big component of the S&P, and that probably needs to come down. This is very interesting to me. So these are the weightings. Apple is 6.9% of the S&P, Microsoft's 5.8, Amazon's 3.3. So those three alone, make up 15% roughly. The industry breakdowns, technology is way over their skis. It's been a massive, amazing ride in technology. It seems like we need a little bit of reversion to the mean. That's why stocks like Okta and MDB and Zoom, and they just have gotten torched and just continued to press lows. It's just way overowned. Sector-wise, I've circled energy is 4%. The median is 7%. So energy could literally double and practically double, I should say, and it would only get to the median as far as percentage. Information technology, 25%. So the median is 16%. Reversion to the mean, it can happen at any time. Most of the time it does happen though, but it's not a great trading strategy. I don't like it because you could go a long time. Like these numbers have looked like this for a number of years, which is why I like to use charts and relative strength. But I'm starting to see relative strength in energy, and information technology has really had a very poor relative strength most of this year, and lately in the last few months, it's really started to turn down. So this is the area that I'm focused on if I want to go long energy. And I own some energy stocks. And like I said, they were up this morning and just the weight of the market, they just couldn't handle it. Now, relative, like a couple of them were still up for the day, but off the highs. I guess we can pull up the charts. And that's no fun, but they're fighting through this market. And if the market ever turns, I think that's the area you want to be. I'll let the market pull me in, but I think that might be the place. All right, so let's pull up the industry groups in MarketSmith. Let me turn off my camera so we can see this much better. Oil, gas, royalty trust is 1. Energy, solar is 2. It's pulled back. They look a bit tired. For solar, tried to break out of like a little shelf or something, got pushed back. Enphase got hit really hard. We'll look at that one. Oil and gas transport is 3. Banks, biotech, energy, coal, telecom. That's interesting. Those might be groups to look at. Oil and gas international, oil and gas machinery, oil and gas integrated. So you can see it's dominated by, I would say, roughly of the top 25 groups. Where do we cut the top 25? What do we have? Maybe 6 or 7 that are energy related, about 28% if it's 7. So that's kind of where there's energy alternative other right in there as well. So that's kind of where I've been focused. Let's look at some stocks in these groups. Like, so let's look at Enphase. Oops. And here's your kind of first shot across the bow right there. The market's fine, it's hanging in there, and then they just get it. And it comes down to, in a bear market, they get them all. tries to bounce and then, just gets slammed a few days ago, down 9%. So this looks like a reset, needs kind of a whole new move. LNTH, which was, kind of did the same thing. One of the clues to me, I think I mentioned a few weeks ago, is these were all the best names, right? Suave, LNTH, Ian, Enphase, Tesla, Apple. They were all holding up. They were all trying to hold up. And this was the day. What day is that? It is 9/22. So I'm going to change my chart to 9/22. So, and then let's look at the NASDAQ really quickly, 9/22. So it's going down. It's not acting that well. But these stocks have been beating their chests, holding up. And it's down, Enphase is down 7% that day. LNTH already broken the 50-day, but was down 3% that day. Tesla down 4% that day. Suave really got hit hard. So this was a huge tell for me about this latest kind of leg down, that when the best merchandise, the model books, the true market leaders, whatever you want to call them, they can't hold up anymore. The weight of the market is just too severe. And even though it didn't seem like that big a deal at that time, I mean, it doesn't look great, that's for sure. But it's time to go. It's time to go. These are shots across the bow when I see this. I usually shoot first and ask questions later. I didn't own any of these. I wish I had owned Suave. I had owned LNTH previously. I think I bought it off of somewhere in here, yeah. But I sold it before the earnings day, which was here. I just more of a market thing than LNTH thing. So, here we are, and they've all kind of, given up the ghost. It's Suave is a little bit better than, but Tesla, much lower than that. Let's look at Apple that day. Was it 9? This day 9/23, so lower as well. So that was a kind of a subtle clue. If you watch the markets, if you're a tape reader like I am, I noticed that day. It was like an alarm bell. Whoa, even these stocks can't hold up anymore. Something's not right. Okay, let's go to some stocks that are of interest. And they're all energy stocks. So EOG, look, so it was down 8 cents today, and if you own it, like relative to the market, that's pretty good action. But at one point it was up maybe 2 or 3. COP, so it was up today, up while the market was just getting hammered. Now it was up a lot more. It gave up some of the gains, but that's what I'm looking for, that type of unusual strength. If the market gets really bad and we go into another leg lower, they're probably not going to be able to handle that weight. And I'm going to have to get out, unfortunately, kind of like what happened in this leg down. But this is where the leadership seems to be. Denbury tried to break out today. Not a big fan of the pattern, but you can see it's making a new high while the market's making a new low. PBR gapped up here, and it was down today, but holding pretty good. You look at the weekly. So I don't know. This seems like the area to be in if you want to be, look at Exxon. So if you want to be or need to be long, I would guess most of us on this call don't need to be long. If you're running your own money or you're running other people's money and you have flexibility, but the big money they have to be long. They have to be in something. Big institutional money, billions and billions of dollars has to be invested. Where are they going to go? That's what you want to try to figure out. This seems like the area, but only time will tell. Okay, so let's go to the quote of the week. Were there any other stocks I wanted to mention? I don't think so. I think those are, I think that's where uh, the action is. Okay. So if you've read Hedge Fund Market Wizards, most of you probably have. If not, I would read it. It's really good. Michael Platt runs Bluecrest. He used to run other people's money, but then he became kind of a family office is what they do, where they have so much money that they can just be a hedge fund in themselves. Look at his gains, incredible. His interview is in Hedge Fund Market Wizards. But he returned client money in 2015. And if these numbers, I was like, wow, this is big money. This is, I don't know how much he has under AUM because it's family office, but it's got to be billions. But this is incredible. But he's up 114% this year, which is that's very, very impressive. Must be short, some macro, some currency. I think he does a lot of that stuff. There's been some dislocations in currency, the yen, the British pound, et cetera. So that's probably how he's been on the right side of those trades. But the reason I bring this up is I thought, oh, I want to use one of his quotes when I saw this tweet about his performance, because I remember reading his and listening to his interview, and I really liked his process. He says, if I enter a trade, the minute I put it on, I feel uncomfortable, I'll just turn around and get out. I do that. I'm not married to anything. I'm just running my own money and some family money, just like him. If I buy XYZ and 10 minutes later, I don't like it, I just get out. I don't have to answer to anybody. It's a freedom that I love to have. It's not my goal. I don't want to do that. I don't want to be, micromanaging every trade, but it's nice to know I have that freedom. It allows me to put on any trade I want because I know I can change my mind anytime I want. I look at each trade in my book every day. I ask myself the question, would I enter this trade today at this price? If the answer is no, then the trade is gone. I kind of do this as well. There have been times where I've been in something and it's like, I want to give it room to breathe, but I just feel like it's going to go down. But here, I want to give it room to breathe. And it goes down like I thought. And somewhere along the way, they'll get me out. It'll get me out. It'll go down more than I thought or something. And I'll get out at a worse price than if I had just said, you know what, I wouldn't enter this trade here today. But being in it makes us value it more. And psychologically, it's a proven fact. What you own, you value more. Everyone, ask anyone what they believe their own home is worth. 99% of them believe it's worth more than the market because it's theirs. There's things about it that they value. So when you own a stock, you have that kind of ownership bias. So it's another great strategy that he uses. Most of the trades I stop myself out of are because of time rather than because of a loss. So you don't have to let something get to your stop loss. If the stock is not doing what you think it should do after a week, a month, a day, I don't know, whatever your process is, it's okay. Most of Bill's losses, or I should say his average loss, the reason we use that 5 to 8% pink zone for the pattern rec, at least kind of one of the reasons or the main reason, is when they studied Bill's trades, his average loss was about 5%. That's the average. That means sometimes he lost 7, sometimes he lost 1, or he lost 3, something like that. His stop loss in his book is 7 to 8. Why is his average 5? Because a lot of times if it wasn't doing what he thought it should do, he would just get out. When I'm wrong, the only instinct I have is to get out. So I would read that chapter. One other thing that he does that I think is brilliant, and I do this as well, is I start at 0 each year as kind of my capital base. And I try to get a cushion before I'll put on more risk. So if I made 50% last year, I don't come into the next year saying, wow, I made 50%. I've got a lot of room to be aggressive here. I say, yeah, that was awesome. Great. I made 50, but I'm back at zero. And I need to grind a little bit, at least initially. So he would give capital to his traders, and he has like a 3% stop on half their capital, and then another 3% stop or something like that, where if you lose 3%, he takes some capital from you. And then if you lose, I think it's half. I really do, if I remember correctly. And then if you lose 3% on that, he puts you in kind of a penalty box. So you start January 1, you basically all he can lose. It's like an option on that money he gave to that trader. All he can lose is 4.5%, 3% on all the money, 1.5% net because he's on the other half because he's reduced it. And so he has a very asymmetric trade with these guys. The most they can lose is 4.5%. And if they get it right, to go up 100%, you know, some of them are going out of the box and pressing. And if you get ahead, you can press, no problem. If you're up 25%, he'll allow you, I would imagine, come all the way down to zero if you want it. You've earned that right to really go for the jugular, to be a pig in that instance. But he starts out from scratch each year. I really like that process. Something I had been doing for a long time, not exactly how he does it, although I like, maybe that's something I should do. Very mechanical, very rules-based the way he does it. Mine is more just instinctual. Let's protect and try to get a cushion. Okay, thank you guys. Stay safe out there. It's a tough market. Marcus Smith at investors.com, 800-424-9033 is the contact information. Have a great weekend, everybody, and we will talk to you next week. Bye-bye.